Hey everyone, welcome back to Corporate Decoder, the place where we dissect the inner workings of the corporate world. This latest filing from Group 1 Automotive Incorporated has some interesting numbers, including a big acquisition and some tough times in the UK. Stick around, because we are diving deep into what it all means for them. And before we get started, if you love getting clear, no. Nonsense insights from these massive financial reports, make sure you are subscribed. We also have a growing community on Discord, linked in the description below, where we break down all sorts of financial news and documents. Group 1 Automotive Incorporated just dropped their quarterly report, and it really paints a picture of a company navigating a complex global market. They operate dealerships across the US and the UK, selling cars, parts, and handling service. Looking at their balance sheet, total assets stand at a hefty $10.4 billion as of the 30th of September 2025. That is a solid increase from nearly $9.9 billion at the end of last year. This growth seems fueled by their acquisitions and a significant jump in goodwill, which is now over $2.2 billion. This suggests they are buying up companies and valuing that brand reputation and customer base they acquire. Now, inventories are a huge part of their business, and it is fascinating to see they sat at over $2.7 billion. That is a jump from about $2.6 billion at the end of 2024. This means they are holding a lot of vehicles, which can be good for sales, but also a risk if demand slows or interest rates keep those floor plan notes payable high. Speaking of floor plan notes payable, that is the money they borrow to buy the cars for their lots. It is over $1.1 billion now. They do have what is called an offset account, which is basically cash they set aside to pay down this debt. That offset is over $400 million, so it helps, but that is still a lot of borrowed money tied up in cars. Let's talk about the money coming in, the revenues. For the 3 months ending the 30th of September 2025, total revenues hit a massive $5.8 billion. That is a jump of over 10% from the same period last year. New vehicle retail sales alone brought in almost $2.8 billion, showing a strong demand for new cars. Used vehicle sales are also booming, bringing in over $1.8 billion, a jump of almost 12%. This shows people are still looking for pre-owned vehicles, which is great for their business model. The constant currency percentage change for total revenues is close to 10%, highlighting that even when you remove the effects of currency swings, their business is growing. Now for the profit, total gross profit for the quarter was nearly $920 million, up from about $853 million last year. That is a healthy increase of almost 8%. However, looking at new vehicle retail sales gross profit, it only increased by about 1.6%, and importantly, the gross margin on those sales actually dropped a bit, going from 7.1% to 6.6%. This suggests that while they are selling more new cars, they are making less profit on each one. On the flip side, used vehicle gross profit saw a slight decrease in dollar amount, but a drop in margin from 5.3% to 4.6%. This is crucial because used cars often carry higher margins. The bright spot seems to be parts and service sales, where revenues jumped over 11% and the gross profit margin stayed strong at around 55.5%. This is their higher margin business and it is performing well. However, their selling general and administrative expenses, or SG&A, went up by over 10%. As a percentage of gross profit, it is now 71.2%, up from 69.4%. This means a bigger chunk of their profit is being spent on running the business. Now let's look at the year. To date numbers for the 9 months ending the 30th of September 2025. Total revenues are up almost 18% to a massive $17 billion. That is quite an increase from $14.4 billion the previous year. Total gross profit is also up significantly by over 16% to $2.7 billion. This is impressive, showing they are growing the top line and managing costs reasonably well on a consolidated level. But here is where things get interesting. Especially in the UK, they had asset impairments of over $124 million this year, compared to zero last year. This is a big number and points to trouble in one of their markets. And then there are restructuring charges of over $20 million, also compared to zero last year. These are costs associated with closing facilities or workforce changes. Diving into the UK operations, revenues are up big time by over 60%. This is largely due to their acquisition of Inchcape Retail. However, the UK gross profit figures tell a different story. New vehicle retail sales gross profit margin in the UK has taken a hit. It was 5.1% in 2024 and now hovers around 3.7% in 2025 on a constant currency basis. This seems to be a major reason for those asset impairments and restructuring charges. The report mentions challenges like inflation, high interest rates, and rising energy costs in the UK. What is also concerning is that SG&A expenses in the UK have more than doubled on a reported basis. Even on a constant currency basis, they increased by over 3%. This suggests that running businesses in the UK is becoming significantly more expensive. Financially, they have over $1.3 billion in fixed-rate long-term debt. Their 4% senior notes are valued at over $732 million, while their 6.375% senior notes are valued around $512 million. Liquidity seems okay for now, with over $988 million in total liquidity available as of the 30th of September 2025. This includes cash floor plan offset accounts and available capacity under their acquisition line. They are currently in compliance with their debt covenants, which is good news. Their adjusted leverage ratio is at 2.9, well below the required 5.75, and their fixed charge coverage ratio is at a healthy 3.5, well above the required 1.2. Looking at their buybacks, they repurchased some shares this quarter, spending about $250 million. They still have $226 million left on their share repurchase authorization. So, what is the story here? Group 1 Automotive is still growing, especially in the US. Their acquisitions are boosting their top line significantly. However, the UK market seems to be a real drag right now. With significant impairments and rising costs, they are making less profit on each new and used car they sell, which means they are leaning even more heavily on parts, service, and F&I income. Which are performing well. The company's strategy to grow through acquisitions is clear, but the profitability of those acquisitions, especially in the volatile UK market, needs close watching. The market has clearly reacted negatively to the UK issues, and it will be interesting to see if they can turn that market around or if it continues to drain profits. Alright, that is our breakdown of Group 1 Automotive Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.